Welcome back to the channel, guys. So in today's video, I'm pretty sure I'm gonna blow your mind because I'm gonna tell you how I bought this $960,000 property for $0 out of my own pocket. So back in October of 2020, I bought this home for $225,000 in Joshua Tree, California. I spent about $45,000 on the down payment. I spent about $25,000 on a light rehab with my dad, and that also included the cost of furniture. So that meant that my total out-of-pocket cost was about $70,000. Now from October 2020 to October 2021, it profited about $20,000 after all expenses, including my property manager. And a quick disclaimer, I am gonna be using rough numbers just for the sake of simplicity, but I am gonna show you my actual tax return so you can compare those numbers with my actual tax return. So because of the $20,000 of profit from my Airbnb, my out-of-pocket cost was about $50,000 for that property. So $50,000, remember that number, okay? So in October of 2021, after about a year of operating this Airbnb, I realized that the market was artificially inflated because of a travel boom that we experienced in 2021. So essentially I wanted to sell my property, lock in a good profit while things were still hot. And in October of 2021, I sold the property for approximately $500,000. But instead of just selling, I opted to use a 1031 exchange. And the 1031 exchange allowed me to defer paying capital gains tax as long as I used the full amount of the proceeds from the sale of the first property and used it as a down payment for another like-kinded investment property. So my proceeds for the sale was about $300,000 because I had about $255,000 of capital gains and about $45,000 from my initial down payment. So that's $300,000. And what did I do with that $300,000? Well, in January of 2022, I decided to take that $300,000 and go buy a $960,000 property in the Bay Area. Okay, so quick recap. I've now bought this $960,000 for essentially $50,000 out of pocket because I initially bought that first home for $50,000 and I'm trading this home for the $960,000 home. Now this is where things get really juicy, so stick with me for a second here. Now the main point of what I'm trying to get at is that this $960,000 rental property is saving me $50,000 in federal income tax in 2022. Again, for some context, I'm a software engineer in the Bay Area, a full-time software engineer. My wife is a real estate agent and she qualifies for a status called real estate professional, and that is crucial for our strategy. So essentially what we did is when we bought this $960,000 property, we performed what's called a cost segregation study. It's basically a third-party service that you can buy where they tell you how much of a deduction you can take in that rental property business the very first year that you own that rental property. After doing the cost segregation study report, we were able to claim a $180,000 deduction in our rental property business for 2022. That $180,000 deduction is what we refer to as bonus depreciation. And the reason why we talk about bonus depreciation on this channel so much, like pretty much in every single video, is because bonus depreciation is going to be your biggest deduction that you get in your rental property business for the very first year that you own that rental property. So that rental property brought in $47,000 of rental income. That's how much we collected in rent that year for 2022. But when we total up all of the deductions that we get for owning that rental property, like property tax, property insurance, mortgage interest, and bonus depreciation, our total deduction is going to be roughly around $227,000. And again, of that $227,000, about $180,000 of that is coming from bonus depreciation deduction. That's why we talk about it so much. So on one side, if you have $47,000 of rental income, and then on the deduction side, you have $227,000, that's gonna leave you with a paper loss of about $180,000 in 2022. And again, that $180,000 basically means that we have $180,000 more deductions in our business than we do income. So this $180,000 loss is what we refer to as a passive loss. And this is a key term if you want to understand real estate taxes. Now, without going into much detail, we were able to use my wife's real estate professional status to essentially use those $180,000 of passive losses against our taxable income from our W-2 and 1099 income. If you want the full details of how we were able to achieve this, then you can go watch that video right here. So now we were able to drop our taxable income by $180,000. So that took us roughly from $400,000 to about $220,000. And according to this federal income tax calculator, if you report that you made $400,000 combined as a married couple filing jointly, you'd be paying around $80,000 in federal income tax. Now, if you report that you made $220,000 as a married couple filing jointly, your federal income tax bill is $34,000. And that's a difference of $47,000. So remember how my out-of-pocket cost for owning this $960,000 property was $50,000? Well, if you factor in the $47,000 of tax savings that we were able to get, now our out-of-pocket cost is just $3,000. Again, these aren't exact numbers, but I just want you to understand how these concepts work in real estate. Now, obviously I shouldn't have to say this, but if you saved $47,000 on your federal income tax, that's gonna allow you to buy more real estate next year, which is then gonna give you more tax savings next year. Now in the video title, I did say that I bought this home for $0 out of pocket, but let me hit you with this. Now, one thing that you might have looked past is the fact that I didn't pay a single dime of income tax on that $47,000 of rental income because I had so much deductions. And on top of that, my tenants actually paid off about $12,000 off my loan balance, my mortgage balance. And so this is what makes real estate investing such a good long-term investment. In my opinion, if you're a high income earner and you're only focusing on the cash flow that an investment can bring in, you're really missing the point of how real estate makes people wealthy. The reality is that you don't really make all of your money from cash flow in real estate investing. You also make a lot of money in real estate from not paying taxes, from appreciation of those homes, and the tenants paying down your mortgage over the course of the next 30 years. Because look, I have a $660,000 mortgage on this $960,000 property. But the thing is that my tenants are going to be paying me essentially $660,000 over the course of 30 years. Now that's $22,000 in the form of equity. It's not in the form of cash flow or cash, but it's still building your net worth because your ownership stake in that property is growing over time. So you can imagine that once you acquire like 10, 20, or even 100 properties, how much equity growth you're getting every single year. And this is how real estate makes people wealthy. Not to mention, if you're using real estate professional status or short-term rental loophole, both of those options can allow you to pay less taxes on your W-2 income. And so for me, I'm saving $80,000 in 2022. So if you're a high income earner, you need to realize that cash flow is not necessarily the thing that's going to make you rich in real estate. In my mind, cash flow is a way to decrease the risk of holding an asset. And what I mean by that is that if you have a property that cash flows $500 per month after all expenses, let's say tough times come and you need to lower the rent by $500 just to get a tenant inside. Well, even at that point, the property is not taking money out of your pocket. And therefore, it makes it easy for you to hold onto that property because you're not paying for it. But on the flip side, if you buy a negatively cash flowing property, you don't really have that buffer. So if tough times come and you lower your rents by $500, now your property is negatively cash flowing by $500 per month, and that's coming straight out of your wallet. Now imagine you have 10 of these properties that negatively cash flow $500 per month. That can mean that $5,000 is coming out of your pocket every single month. But the main point is, if you're a high income earner, you can eat those costs. You can still be safe without the cash flow from those properties because you're making so much money anyways. Now, don't get me wrong, I'm not saying buy negatively cash flowing properties. My long-term strategy is essentially to buy a quality rental in a good location every single year, which is self-sufficient, which basically means that the rent that I can collect essentially pay for my monthly expenses for owning that home. With this approach, I should be able to scale to owning more than 100 homes because none of the homes are taking money out of my pocket every single month. And not to mention that the very first year that I buy that rental property, I'll be using real estate professional status along with bonus depreciation to help me save like tens of thousands of dollars on my tax bill for that calendar year. And then of course, I'm going to be using those tax savings to go buy more real estate the following year. Now I understand right now is a very high interest rate environment, so it's very hard to find these self-sufficient homes, right? Especially in quality locations. But the one thing you have to understand is that rents are only going to go up from here in the long term, and interest rates in the short term, I'm expecting that interest rates are going to come down within at least the next 2 years. So if it breaks even today and interest rates drop, then I can refinance and generate some cash flow there. Now, please remember, if you're making $60,000 a year, then obviously cash flow is going to be a higher priority for you because for you need to build your income. But if you're making over $300,000 a year, the significance of you not paying those federal income taxes is such a big factor, and it gets bigger as your income increases. And that's why typically my channel is geared more for investment strategies for high income earners than someone who's making, let's say, $60,000 a year, just because the style of investing is different for someone who's making $60,000 versus someone who's making $500,000. So if you found this video helpful, give me a thumbs up, give me some feedback on the video, let me know if it was useful or not. If you want to learn more about paying less federal income tax on your W-2 income so that you can go buy more real estate with those tax savings, then go check out these videos right here. It applies even if you are not a real estate professional, so those videos are right here. So that's it for today. Consider subscribing if you haven't already. I post videos once a week on Sunday mornings. Thanks for staying till the end, guys, and if you guys want to schedule a call, again, the link is in the bio. See you next week, guys. Peace out.